Hello everyone, welcome back. I got another really good one for you today. Second video for the day, but hey, we're on one right now, I guess. Wanted to do this video about technical analysis, but wasn't really sure how to weave it into the last video where I kind of give you market updates and discuss Fed expectations. But for a while, I've been wanting to do a video about technical analysis. You've noticed I've never used any like charts or visual aids really. I would say technical analysis works to the extent that when you put mirrors on your car, it allows you to drive better, maybe avoid some accidents. But if you were to drive looking through your rear view mirror, probably going to hit a pole. And you might be looking through that rear view mirror like, oh, I knew the road had been straight enough for so long that eventually I was going to need to turn. Like, of course I should have turned. But you see how technical analysis is looking into the past and then using price data points like right now to kind of drive forward into the future, and how that might not be the way when markets ultimately trade on expectations and are very forward looking. I've used TA, like gone pretty far down the rabbit hole. At one point I thought maybe TA was the truth and just being a chartist and a technician was the only thing that mattered, because it didn't really matter if you were trading pencil erasers or Long Islands. The chart is all that matters. What is happening is all that matters. And with a paradigm like that, maybe you could just get rid of like fundamentals and market noise and just focus on the chart, eke out an edge. Even if you were only 60%, winning and 40% losing, you could still manage your risk well and make a really good living. That's like the whole paradigm of the technical analyst, the TA guy, the chartist. But I'd say I would only ever let technicals be like 20% of the picture for you. I think it's just my opinion and my experiences with it. And there are technical indicators I like, okay? So I'm not here to just completely, hate on TA. I like volume as an indicator. I like price action, what it's doing. I would say there are some technical indicators, like maybe you could use loosely 200-day moving averages to kind of give you an idea of what to trade. So I'd say loosely apply technicals to your trades maybe, but don't let it be the end-all be-all, and know you're only dealing in the realm of probabilities. So let's say you found some technical indicators. You were like, I'm going to use MACD, stochastics, Bollinger Bands. This is just an example. Volume, and with that combination of technicals, I'll be able to eke out an edge and trade profitably. And if it, I know it works and I can back test it, then you made it. But the problem is there's really nothing there. Like, you're basically, a lot of technicals is looking what already has happened and not what's going to happen. And what has happened, it only predicts the future, that maybe to the extent that other people are using technicals. Like they're looking at the chart too. So when you find these little chart ranges, the only reason that technicals works and you're able to like buy those dips and sell those highs is because other people are looking at it. But the problem with that is now everyone, like, now down is up and up is down. And a lot of these large firms that are day trading against retail traders, institutions with unlimited buying power, they're able to actually use technicals in a way that smokes you. It front runs your trades, it runs your stop losses, it essentially steals all your money like a slot machine would, and converts over a long enough time period your reality to theirs, all your money to them. You could sit down at a slot machine and win for a while, call it like you could win for 2 days straight, but the casino knows on a long enough time frame they got you. And I would say using technical analysis as a retail trader, it's the same concept. These firms know what you're looking at. These robots know what you're looking at. They're driving a Ferrari, you're racing them in a horse and carriage. So I would only use technicals to a very limited extent. I might look at the volume, I might look at the price action, I might look at whether or not it's trading above or below the 200 MA. But really, I'm going to take a pretty limited approach to my technicals. And ultimately, the best indicators, I think, are sentiment. I think market sentiment combined with technicals and fundamentals maybe could kind of give you an edge. But even then, the market is it's not wholly efficient, 100% efficient, but it's quite efficient. And so you're like, okay, I need to find the prettiest chart for the best stock with like the best technical setup. Okay, well, if you're using the same book as everyone else, same playbook, all of y'all found that, and now some institution is going to come in and they're going to take the opposite side of the trade. They're going to smash you down to your stop loss and then run everyone's stops. They're just going to mess with your head and take all your money. So use technical analysis like you would use a rear view mirror on a car, but don't let it drive you and don't let it drive the decisions you make, because ultimately this market doesn't care about what has happened, it cares about what is going to happen. And these technicians that are out there like, well, markets always overshoot and they always undershoot, and we can kind of, leverage that and get in at the right time. Yeah, and then get railroaded because the market's doing as much damage to as many players as it can at once all the time. I think the best thing that you can ultimately do isn't some technical holy grail combination of indicators, but you should understand, loosely how it works. And then maybe apply another 20%. So make 20% of your strategy, like in the picture technicals, 20% fundamentals, 20% sentiment, and then just kind of know that other 40% left is just kind of like the luck, just how even a professional poker player can only push their skill limit to a theoretical amount. Meaning, if you play poker and you're pretty good, it might be 50% skill for you, 50% luck. But if you come across a professional, they've pushed that threshold to 80% skill, 20% luck. There's still that 20%. Does that make sense? That's luck. People are going to be like, oh, well, poker is a luck game or it's a skill game. It's both. It's both at the same time. And so are these markets. So you can apply technicals, but don't have this paradigm where you're like, I'm going to go 50% technicals, 50% fundamentals, and then I'm going to know the truth. It's like, no, because as soon as you get there, the market already knows the truth, has priced in that truth, and is setting you up for complete failure. Like, I'm quite convinced I could start a prop trading desk, invert all the technical indicators, like basically teach them how to use TA, technical analysis, then invert all their indicators, and then I'll like make money. Like, I feel like if you like teach someone TA and show them the way and then sit them down, they're just going to get railroaded by the market. Like, I wish there was a way that sometimes whenever someone thought it was a good idea to buy, they actually sold. Whenever you think it's a good idea to sell, you actually buy. And then you would actually start to probably make some money. Maybe not, but you can kind of see how the market stays one step ahead of you, no matter who you are. So you could apply technicals, apply fundamentals, apply sentiment, and then know that you can't really model human behavior too accurately, nor can you model unknown unknowns. So like those are your black swans, like your FTX. Like, that was a bit of like a pink flamingo, because I mean, if you look back on it in hindsight, you're like, oh, this totally makes sense. I should have seen this coming a mile away. But you can see how like events occur, like with FTX, that no model could have predicted, these liquidity events. And if no model can predict that, then your model essentially works right up into the moment that it doesn't. And these models and algorithms that these firms are using, they're processing trades in they're processing information in like a millisecond. They're auctioning off space, like proximity to the NYSE exchange and servers, so that they can get data a millionth of a second faster than their competitors. I mean, that's kind of the level you're playing at. So if you're going to try to, you know, get 3 monitors, you know, and get this sexy setup with all these clicks and whistles on it and have all these indicators, you know, honestly, past like 3 or 4 indicators, you're shooting yourself in the foot, because you're starting to create so much noise, you can't process what's going on. And even if you're a really good trader and technical analyst and chartist, you still have to be ready to flip tails 30 times in a row. And I don't know how many portfolios, you know, can survive that. And it's going to happen to you eventually. So are you going to be able to have an investment strategy that can make consistent profits and flip tails 28 times in a row and still have you be solvent? Another thing is, a lot of these algorithms that these, you know, that these quants come up with and these high frequency traders come up with, these models work, but then they don't, you know, because somebody else comes up with a model to fight the model, and now it's just battle bots. You got a game of battle bots going. And how long are you going to be able to go before you really know your model's broken? Like, how many losses are you going to incur before you're like, dude, I think there's a real problem and we now have to, you know, reassess our entire strategy here. So it's crazy. The market's not a zero-sum game because the Fed's always pouring money in from the inside out, and there are times where, you know, like FTX's case, money poofs, it disappears, massive deflations. So it's kind of like this open system with money sloshing in and sloshing out. But trying to eke out an edge in it, especially on a daily basis, and using TA is going to feel like a zero-sum game. Like, you're going to battle for every dollar you make, you know. So be careful with the charts, all right? Just a quick video, my thoughts on TA. I'm not like a hater. And if you find the Holy Grail, like, this is just my perspective. So if you find the Holy Grail, some combination of indicators that works for you, first thing, don't tell anyone. Second thing, you know, enjoy it. Just keep in the back of your mind it'll work until it doesn't, because the rules of this game change as we play, and because the past pricing behavior doesn't really necessitate what's going to happen in the future. So just keep that in the back of your mind, and we're going to proceed, all right? So TA is cool, but not the end all be all, and you don't really need to do more than just look at the chart, look at the price action, so like what it's doing, look at some volume, look at maybe some moving averages, and then beyond that, once you get into Elliott wave analysis or Fibonacci or stuff, you're seeing patterns that oftentimes simply are not there. Okay, so don't overtrade, don't get inside your own head, don't start seeing patterns that aren't there. And TA is just a siren. She lures you in and then just crashes you onto the rocks. So just my thoughts on TA. Quick video. Hope this finds you doing well. Like, subscribe, share, comment, whatever. You guys are awesome. Till next time.